In this video, I wanted to cover a few of the concepts that I find newer traders struggle with the most. And actually, the first of those things that I find new traders really have a hard time with are how exchange rates actually work, why they change, and what creates that opportunity for profit or potentially loss. So let's turn this into an analogy. Let's imagine that you live in the US and you're going to take a 3-month vacation to Europe because you're a very successful trader. And you're bringing with you $5,000 to spend while you're in Europe, so you have some spending cash. And of course, in Europe, their currency is the euro, not the US dollar. So you're going to have to change those dollars into euros. Well, right now the exchange rate is 1.45. That means that it costs $1.45 to buy a euro. So almost $1.50 to buy a euro. That means that we'd be able to exchange the $5,000 for 34.48 euros. So pretty straightforward. Here's the calculation for that. It's just 5,000 divided by the exchange rate. So pretty simple. Now here's what happens. Over time, the relationship that the dollar has with the euro, so its relative value, will change. And that exchange rate changes. So 3 months later, it's time for us to go home. And we turned out our wonderful hosts paid for everything while we were there, so didn't have to use any of that spending money. We still have that 34.48 worth of euros. So still have those euros. We're going back to the U.S., which means that we're going to want to change them back into dollars. Well, now the exchange rate has changed. So the relative value of the dollar to the euro has changed, and the dollar's actually gotten a little weaker. So instead of costing $1.45 to buy a euro, it now costs $1.50. So $1.50 to buy a euro. That means that when we exchange these into dollars, because the euro has actually gotten stronger, we're going to get $5,172 back. So we actually made a little profit here of $172 on our vacation. Not too bad. Going back into the U.S., we have a little bit more padding in our wallet. You can see the calculation here for that. Because we're reversing the previous equation, we're multiplying here instead of dividing. So pretty simple concept, and the only thing that you have to do to really understand how that works is run through that same analogy yourself. Replace any currency you want, whether you're looking at the euro dollar or the dollar franc. Now, before you do that, however, there are a couple of terms that you have to understand. And these seem pretty simple on the surface, but there is some complexity that you really need to think through as you're beginning to work in the foreign exchange. Now, these terms, of course, are pair. You know by now that currencies are traded in pairs. It's one currency's value versus another currency's value. And those values, or that exchange rate, that foreign exchange rate, will change. Those two currencies have labels on them. There's the quote and the base currency. So the quote currency comes last and the base currency comes first. So if we're talking about the euro-US dollar pair, the quote currency is the dollar and the base currency is the euro. Finally, those changes in price happen in pips, that's the minimum price movement that can happen on a currency pair, generally, is 1 pip. And each pip has a value depending on how you're trading. So let's take this to an actual chart, and let's look at a chart and see how this plays out. Right now, we're looking at a chart of the euro-US dollar exchange rate. So you can see that up here at the top, euro-US dollar. And it would be annotated like this, with the dollar on the right-hand side and the euro on the left-hand side. The euro is the base currency, and the dollar is the quote. Now, there's a really easy way to remember how this works. If the euro dollar is being quoted in dollars, so we would refer to this as, right now, the exchange rate is $1.4576. So $1.4576 to 1 euro. It's being quoted in dollars. The base in this case is the euro. A great way to think about this is a bit like a seesaw here. The euro being on the left-hand side and the dollar being on the right-hand side. If the euro is getting stronger or heavier, it's going to tilt the seesaw down so that the seesaw's board is going to tilt down in favor of that heavier euro, and the pair is going to rise. The exchange rate is going to rise. So you can see over the months of October and November, this seesaw was tilted in favor of the euro, a stronger euro compared to a weaker or lighter dollar, and the exchange rate was rising. Subsequently, from mid-November through mid-December, we saw that the fundamental weight of each one of these currencies shifted in favor of the dollar. So we saw the dollar gaining in strength against the euro, and it was shifting this seesaw down. So this is a good shortcut to try to remember, if some good news comes out about the dollar, what direction do I think the euro dollar should go? Well, it should go in the direction that the seesaw would predict. Or if we get really good news about the euro, what direction do we think that the exchange rate should go? Or bad news about the dollar, oh, it should tilt back up and the exchange rate should go back up. Over the last few months, at least on the whole, the market has been fairly evenly balanced on this little seesaw. So we've had a lot of back and forth, this little zigzag pattern in the exchange rate. So forex traders maybe have some shorter-term forex traders may have been making some profits as the market goes up and down, and longer-term traders have probably been waiting there, a little bit bored on the seesaw, waiting for it to tip one direction or the other.